On March 27, 1980, the world watched in awe as silver surged past $50 an ounce, a price that seemed preposterous, impossible, even absurd. But at that moment, two men from Texas held in their hands a fortune bigger than most nations could claim. The brothers, Nelson Bunker Hunt and William Hunt, had spent 3 years quietly accumulating nearly all the available silver supplies in private hands, contracts, futures, bullion, until they controlled an amount so vast it dwarfed even national reserves. For a brief, shimmering instant, they appeared to hold the world's richest metal under their fingers, and the dreams of tens of millions of retail investors rose alongside the silver price. Then, within 48 hours, it all shattered. By March 28th, the price collapsed to $11 an ounce. The shine vanished, fortunes evaporated, savings gone, and the mighty empire of silver built by the Hunts collapsed like a house of cards. It seemed like a market crash, a supply-demand collapse. But that's not how it happened. What killed silver that night wasn't greed or panic or shortage. What broke silver was power. It was the institutions. It was the regulators. It was the exchange. It was the moment when the rules of the game were changed, quietly, suddenly, without warning, swapped under the feet of every investor who believed in their contract, their position, their faith in the system. Silver didn't die because of over-speculation. It died because someone with the power to shift reality decided to pull the rug. And the victims? Retail investors. The collateral? Trust. The cost? Billions. But history doesn't end there. Because today, more than 4 decades later, the same playbook is unfolding again, in plain sight, under the radar of mainstream media, bundled inside vaults, hidden behind authorized participant lists, and masked as institutional accumulation. Except this time, the giants aren't two oil-rich Texans. They are global banks. They are vault operators. They are institutions with balance sheets bigger than many countries. They are the architects. And for once, retail investors are lining up to hand them the keys. If you want to understand what's happening now, if you want to see the trap being reset, piece by piece, you need to go back. Back to 1980. Back to the collapse they don't teach you about. Back to the moral that once money loses its anchor, everything becomes a game. And if you think climbing onto silver at 100, at 150, or at 200 an ounce is a bet on survival, think again. Because in that world, the game ends only one way. They walk away with billions. You pay the price. To understand how silver became a battleground, you have to travel back to the 1970s, an era when the world economy was in upheaval, when confidence in money began to fracture, and when the shining promise that once backed every dollar started to slip silently away. In 1971, when the United States severed the last link between the dollar and gold, it didn't just change a monetary policy, it tore out the foundation of trust that had held the global financial system together since the end of World War II. Overnight, money became untethered. The anchor was gone. Paper replaced metal. Promises replaced guarantees. Nations held dollars knowing they could no longer demand gold for them. This shift triggered a wave of uncertainty. Inflation surged, currencies weakened, governments borrowed more, budgets expanded, and citizens began to feel the pressure, though the real effects were masked behind economic jargon, interest rate adjustments, and policy reports. But for those with foresight, those who saw beyond the walls of Washington and Wall Street, a different story emerged. Money was no longer a safe harbor. It was a sinking ship. For the Hunts, that moment was an opportunity. For millions of ordinary citizens, it was a warning unheeded. Because when faith in money fades, people search for value. They search for something they can hold, something tangible, something real. And that something was silver. So the Hunts began quietly buying. Ounces, contracts, futures, storage fees paid, vaults lined up, until their accumulation became impossible to ignore. Prices rose naturally, at first slowly, then violently. Silver soared from under $6 an ounce to $40, then $50. And every new dollar printed, every ounce of gold drained from vaults, pushed buyers further down the rabbit hole of greed and desperation. For a moment, it looked like justice. A correction, a redistribution. Old money, new money, small investors. All saw the same charts. All felt the same fear of inflation. All jumped in, but there was a catch hidden inside a contract, a clause that meant nothing until they needed it. The story you're about to hear doesn't appear in most documentaries, isn't taught in economics classes, and isn't something the financial elite enjoy revisiting, because at its core lies an uncomfortable truth. Markets don't crash. They get crashed. And in January 1980, the most powerful commodities exchange in the world proved that when prices rise too fast, too high, or too far outside the control of the institutions who built the system, they do not sit back and allow the invisible hand of the market to decide the outcome. They rewrite the rules, and the Hunts never saw it coming. By late 1979, silver was exploding. The price had ripped past $20, then $30, then ticked toward $40 with no signs of stopping. Every banker, every regulator, every trader with a seat on the Comex floor knew exactly what was happening. The Hunts had accumulated one of the largest private silver positions in modern history. Retail investors were flooding in, desperate for protection from runaway inflation. The dollar was collapsing in purchasing power. Gold had broken above $500 and was heading toward its historic 1980 peak of $850. And confidence in the U.S. monetary system was unraveling, faster than Washington was comfortable with. Behind the scenes, meetings were held at the Federal Reserve Bank of New York. Phone calls were made to the Treasury. Urgent memos circulated between Comex officials and major banks. Not because the Hunts were breaking the rules. Not because they were committing fraud. Not because the silver market was dysfunctional. But because the people who normally controlled the price were no longer in control. That was the real emergency. Early that month, with silver approaching $50, the Comex implemented a change that would go down in financial history as one of the most controversial rule adjustments ever made. They called it Silver Rule 7 Liquidation Only. But what did that actually mean? It meant you could sell silver. You could close your position, but you could not buy more. The market was still open, but buying, the lifeblood of any rally, was outlawed overnight. To illustrate the insanity of this, imagine the stock exchange announcing that Tesla or Apple or Amazon shareholders could only sell, not buy, until further notice. Prices wouldn't fall, they would collapse. And that's exactly what happened to silver. The rule change triggered a chain reaction the Hunts were powerless to stop. Margin requirements skyrocketed, making positions suddenly unaffordable. Lenders pulled credit lines, brokers demanded more collateral, or threatened immediate liquidation. Retail investors were left dazed, unable to buy the dip even if they wanted to. And as the dominoes fell, someone lit the match. Silver futures, once roaring at $50, entered freefall, $44, $38, $29, $20, and by March 28th, a date etched into market history, silver crashed to $11. In 2 days, the Hunts lost billions. In 2 days, the public lost their savings. In 2 days, one of the greatest wealth transfers in American history quietly took place. When asked later how he lost his empire, Hunt didn't blame speculation. He didn't blame greed. He didn't blame volatility. He didn't even blame his own strategy. He blamed the rule change, a targeted, surgically precise intervention. His words were chilling. We were ambushed. They changed the rules to suit themselves, and he was right. The exchange insisted it was protecting market integrity. But to anyone who understood the power dynamics at play, the truth was far simpler. The Comex protected the banks. Not the market, not the investors, not the system. Because the banks were short, deeply short, dangerously short, and if silver continued rising, they would have been wiped out, melted down by the very metal they tried to suppress. 45 years later, the same script returns. But this time, the Hunts aren't the threat, the banks are. Before we jump into the modern setup, you need to understand something. In 1980, the Hunt brothers were outsiders. They were oil billionaires, but still outsiders. Today's silver giants are not outsiders. They are the system. And the most important one, the one whose name appears in nearly every vault report, every futures ledger, every banking scandal, every metals investigation, is J.P. Morgan. To understand the trap being built today, you need to follow the silver. Follow the vaults, follow the contracts, follow the positions. And when you do, something shocking appears. J.P. Morgan has quietly accumulated over 1 billion ounces of physical silver. Not rumored, not speculated, not a conspiracy. Documented, recorded. Publicly reported through Comex vault data between 2011 and 2020. Over 30% of annual global production hoarded by one institution. Let that sink in. The Hunts tried this once, and they were crushed. J.P. Morgan has done the same thing, but legally, systemically, slowly, and under the protection of the very exchange that destroyed the Hunts, while the public stacks coins, while investors chase ETFs, while YouTube channels scream, buy silver before it's too late. JP Morgan has built the largest private silver hoard in modern history. But that's only half the story. Because while they hold this mountain of physical silver, they are simultaneously short the paper market, meaning they hold the metal, but they're betting the price will drop. Betting that when the crash comes, they'll profit. Betting that when silver spikes toward $200, the public will buy the top, and they'll be the ones selling into the frenzy. Just like Comex did in 1980. Just like the Hunts couldn't. Just like the playbook demands. Before we dive into the mechanics of the trap, you need to understand something fundamental about silver. Something every banker, bullion dealer, and commodities regulator knows, but almost no retail investor ever thinks about. Silver is not a precious metal in the eyes of the financial system. It is a pressure valve. And pressure valves cannot be allowed to blow. In 1980, silver breaking $50 wasn't dangerous because of the Hunts. It was dangerous because of what it symbolized. A failing dollar, a public waking up to inflation, a rush out of the banking system, and the threat of a monetary panic. Today, the danger is bigger, far bigger. And that's why the $200 level is not just a price target, not just a bullish prediction, not just a number pulled from a chart. It is the line in the sand where the banks, led by JP Morgan, cannot allow the price to go higher without losing control of the entire system. To understand why, follow the numbers. At $30 silver, JP Morgan's physical hoard is worth roughly $30 billion. At $50 silver, that becomes $50 billion. At $200 silver, the value explodes to $200 billion. That means if silver ever rallied to $200 per ounce organically through normal market forces, JP Morgan would have the single most powerful financial weapon in the entire commodities universe: the ability to liquidate tens of billions of dollars of silver into a surging market and detonate every short seller and leveraged trader in the system. But here's the twist. They don't want that. Not because it wouldn't be profitable. It would be the greatest trade in corporate history. But because a silver price of $200 isn't a metals event, it's a currency crisis. Silver at $200 means the dollar is collapsing. Inflation is out of control. Confidence in government bonds is evaporating. The banking system is losing credibility. And retail is stampeding into hard assets. In other words, $200 silver is the exact point where the public stops believing in the system. And the system cannot let that happen. That is why the rug gets pulled at $200, not because the price is too high, not because silver is overvalued, not because of supply and demand, but because the system needs to protect the illusion that fiat currency remains the ultimate store of value, and nothing shatters that illusion faster than a metal breaking out of their control. What makes this moment so terrifying isn't that banks are manipulating silver again. That's almost expected by now. But that they are doing it with a calm, patient, almost surgical precision that feels less like a financial strategy and more like the slow tightening of a noose around a market that doesn't yet realize it's being strangled. And the strange thing, the eerie thing, the thing that should make every silver holder shiver, is that the entire setup looks exactly like the years leading up to the Hunt brothers' collapse. Except this time the people running the playbook are not reckless billionaires gambling with borrowed money, but institutions with unlimited capital, unlimited political coverage, and unlimited control over the very rules that decide who wins and who loses. If you want to understand this moment, truly understand it, you have to imagine the silver market as a long, dark corridor with 3 locked doors at the end, and the banks are the only ones holding the keys. The first door opens quietly, almost innocently, with no alarms and no warnings, during a period of years when the public isn't paying attention, when analysts are distracted by stocks and housing, and when silver barely moves enough to make headlines. Yet, behind the scenes, vault managers, bullion banks, and traders who don't appear on camera are directing enormous volumes of metal into their possession, stacking it slowly and silently until the mountain is tall enough to look like an accident, but intentional enough to feel like preparation. This is the accumulation phase, the part of the story where nothing seems to be happening, even though everything is. Then suddenly, without a single announcement or official signal, the market shifts. Silver begins to rise, first gently, almost like the twitch of an awakening animal, then, with more confidence, then with the sharp, unmistakable energy of something that has been held underwater for too long and is now fighting its way to the surface. And as the price creeps upward, $28, $33, $40, the public starts to notice. Social media lights up with excitement, financial channels scramble to explain the move, and investors who wouldn't have looked at silver twice a year ago suddenly begin watching the charts like they're reading a prophecy. This is the ignition phase, the moment when the banks need retail enthusiasm, when they need the crowd to stampede into the trade, when they need the story to look like a revolution that came from the people rather than a trap engineered from above. Because a trap only works when the target walks in willingly, and no trap in financial history has ever been more effective than a rising price that's about to be stolen from beneath the feet of everyone chasing it. And the final phase, the one nobody ever sees coming, arrives not with panic or chaos, but with an email, an announcement, a quiet regulatory statement from the same institutions that claim to maintain order in the markets. A single rule change, a margin adjustment, a new limit, a temporary restriction. Always framed as protecting investors, always justified as reducing volatility, always presented as a measure of safety rather than an execution. Yet beneath the polished language and the legal wording is the real message. The banks have made enough. The public has made too much. It's time to pull the plug. And just like that, the rules tilt. Just like that, buying becomes harder and selling becomes easier. Just like that, leveraged positions begin to unwind. And just like that, the exact same strategy that destroyed the Hunt brothers is deployed again. Only this time, the people controlling the game don't just benefit from the crash, they orchestrate it. And as silver plunges, first 5%, then 10, then 20 in a single day, every person who celebrated the rally finds themselves staring at collapsing charts, frozen screens, margin calls, and exchanges that shrug their shoulders and say, "We're simply following procedure," when in reality those procedures were sharpened deliberately for this moment, for this price level, for this trap that was designed years ago, long before the first retail trader ever bought their first ounce. Because the truth, the painful truth, is that the silver market today is not a battleground between buyers and sellers, or between bulls and bears, but a slow-moving reenactment of a script written in 1980, a script the banks know by heart, a script they will use again, and a script that always ends with the same final scene. The institutions walk away with profits. The public walks away with losses. And the metal that was supposed to set them free becomes the same metal that traps them. To understand how dangerous this moment truly is, you have to go back. Not to the crash, not to the screaming headlines, not to the lawsuits or the bankruptcies or the finger-pointing that came after, but to the quiet weeks and months before silver collapsed in 1980, when the Hunt brothers genuinely believed they were about to reshape the financial world, unaware that the world they were trying to reshape had already decided their fate. It didn't happen suddenly. It didn't happen dramatically. It didn't happen with any warning at all. It began with whispers, tiny whispers, the kind you only hear when you lean close enough to the machinery of power to feel the gears turning under the surface. The Hunts weren't paranoid. They weren't reckless cowboys chasing a fantasy. They had real metal, real leverage, real influence, and real reason to believe the system was about to tilt in their favor. They had a simple thesis, really. If inflation was exploding, if trust in the dollar was breaking, if the world was drowning in paper promises, then physical silver would become the ultimate safe haven. And for a moment, a brief and shining moment, they were right. But they never understood the rule that governs every financial empire. You can bend the system only when you are part of it. You can never bend it from the outside. The Hunt brothers weren't insiders. They weren't regulators. They weren't banks with political shielding. They were wealthy, powerful, famous, but still outsiders. And the moment their accumulation became too large, the moment their buying pressure started shaking a market that Wall Street believed it owned, the gears began to turn. Meetings were held. Calls were made. Concerns were voiced behind polished doors in buildings with marble floors and federal seals on the walls. And slowly, quietly, the same institutions that spent years watching the Hunts accumulate silver suddenly decided the integrity of the market was at risk. But integrity wasn't the issue. Control was, it always is. When the price hit $50, the system didn't break. It reacted. The regulators didn't lose control. They exercised it. And the moment they announced liquidation only, the fate of the Hunts was sealed. Their empire dissolved in hours. Their billions evaporated in days. And the world never forgot how quickly a market can collapse when the people who write the rules decide the game is over. And here's the part that should genuinely terrify anyone in the silver market today. Everything the Hunts did wrong, the banks have corrected. Everything the hunts attempted publicly, the banks have done privately. Everything the hunts were punished for, the banks are rewarded for. The Hunt brothers bought too fast. The banks accumulated slowly. The hunts used leverage. The banks use both sides of the market. The hunts threaten the system. The banks are the system. That alone should make you uneasy. But it gets worse because, as strange as it sounds, the most important similarity between 1980 and now isn't the price or the accumulation or the buying pressure. It's the silence. Before the 1980 crash, the public didn't see the danger. Before the 1980 crash, traders believed they were unstoppable. Before the 1980 crash, silver felt like destiny. And right now, we are living in that same eerie twilight, the moment before the storm, the moment when everything feels calm because the people with the power to create chaos haven't flipped the switch yet. But the moment silver charges toward that danger zone, the moment the price accelerates past what the system can tolerate, the moment the narrative shifts from growth to threat, the same playbook will snap into action, the same gears will turn, the same institutions will whisper the same warnings behind the same doors, and the same rule changes that destroyed the hunts will be used again, only this time with more leverage, more political protection, and more trillions at stake. Because the lesson of 1980 wasn't that the hunts were reckless, it's that the system will always defend itself, even if it looks like brutality. And that is exactly the world silver investors are walking into today, without realizing that the ground beneath them has already been prepared for collapse. If you want to understand what comes next, not the price targets, not the hype, not the recycled predictions about shortages and demand, but the real endgame behind the bank's positioning, the part that never makes it onto CNBC or into analyst reports, the part whispered in boardrooms and embedded inside internal risk models, you have to start by asking one question the average investor never even thinks to ask. If banks hold massive physical silver, and at the same time hold massive short positions, what outcome makes them the most money? It's not steady prices, it's not a quiet market, and it's definitely not silver drifting sideways at 25 and boring everyone. The most profitable scenario, the one the system has already been positioned for, is a violent, euphoric, headline-grabbing spike. A spike so fast and so dramatic that retail investors rush in with both hands. A spike so emotional it triggers fear of missing out on a once-in-a-generation breakout. A spike so extreme that it forces global media to scream about a silver revolution. A spike so powerful it stretches margin requirements to breaking point. And a spike so high that it creates the perfect excuse for regulators to intervene. That's the secret. That's the hidden mechanism. That's the blueprint the banks learned from watching the Hunt brothers get destroyed. The Hunts tried to corner silver. The banks are trying to corner the reaction to silver. Because when you hold a mountain of physical metal, you benefit from rising prices. And when you hold huge short positions, you benefit when the market collapses. But when you hold both and you can influence the rules, you benefit twice. You win on the way up. You win on the way down. Everyone else loses at both ends. It's the perfect trap. And here's how it works. As silver surges higher, the bank's physical holdings explode in value, turning billions into tens of billions. Retail FOMO kicks in. New traders flood into paper silver contracts. Influencers scream 100 silver incoming. The public becomes liquidity. Exit liquidity. For the institutions who have been waiting patiently for the moment the emotional peak arrives. Once silver approaches that critical zone, call it $80, call it $120, call it $200. The exact number doesn't matter as much as the psychology. The system begins preparing for the rule change window. It happens quietly at first, just like in 1980. Tightened margin requirements, increased volatility checks, regulatory concerns about market stability. Then, at the exact point where retail exposure is highest, where leverage is stretched thin, where excitement is turning into mania, the banks start unwinding their longs and expanding their shorts. And right when the imbalance becomes dangerous for them, not for you, not for me, not for the market, but for them, the rule changes arrive. A sudden shift to liquidation only. A temporary ban on new long positions. A margin requirement spike so severe, it forces immediate selling. And that's when everything collapses. Silver doesn't fall slowly. It doesn't correct. It implodes, violently, shockingly, brutally, exactly the way it did in 1980. Retail investors are wiped out. Leveraged buyers are destroyed, odd ETFs bleed. Miners crash. Sentiment fractures for a decade. all while the banks make billions on the way down, protecting their physical holdings and harvesting profits from their short positions. The perfect trap closing exactly the way it was designed. But here's the most disturbing part of the story, the part people don't want to believe, but the data keeps screaming. The trap doesn't work unless silver first explodes upward. The crash can't happen without a boom. The rug pull requires euphoria. The rule changes require justification. And the banks need the public fully committed before the hammer falls. That's why the whispers have returned. That's why accumulation keeps rising. That's why positioning looks eerily similar to the months before the hunts were destroyed. Not because silver is destined for $200, but because the system needs it to reach a point of mass vulnerability before it pulls the same lever it pulled in 1980. And unless you understand this, unless you recognize the pattern, unless you stay conscious of the historical playbook repeating in real time, you will walk right into the same trap the Hunt brothers fell into. Blinded not by greed, but by a belief that the system is fair when it has never been fair. Because the real story of silver isn't about metal. It's about power. Who has it? Who doesn't? And who gets sacrificed to protect it? And we are approaching that moment again. So here's the truth stripped of all illusions. The Hunt brothers weren't destroyed because they were reckless. They were destroyed because they broke into a game they weren't allowed to win. Today, the same game is being played again. But now, the players have changed. The banks aren't fighting the system. They are the system. They hold the metal. They control the paper. They influence the rules. And when silver finally surges, whether it's 80, 150, or the mythical 200, that's not the moment to celebrate. That's the moment to pay attention. Because markets don't collapse by accident. They collapse when someone with power decides it's time. The banks won't warn you. The regulators won't protect you. And history won't save anyone who ignores its patterns. But you, now that you know their playbook, now that you've seen the blueprint behind every spike and every crash, you don't have to be their exit liquidity. The silver story isn't just about metal, it's a mirror. It shows exactly how the world works. Who pulls the strings, who pays the price, and who walks away with the money. The Hunts learned it in 1980. Millions of investors will learn it soon. But you're already ahead of the trap. And that makes all the difference.